Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group. I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what's going on in the markets?
Yeah, thank you, Jeremy. Thanks for our listeners jumping on the call. Volatility, we saw risk assets fall sharply for 3 days as investors were really assessing the whole AI economic impact. So we saw the Nasdaq, that area where houses a lot of these names, that was up about 2% on Friday with a rebound, but down 1.8% for the week. We saw the S&P 500. That's cap weighted, leaning towards that tech area. That was flat for the week, but we saw small caps outperforming. So we saw the Russell 2000 up about 2%. We saw the MidCap 400 area up about 4.4%. And we saw the S&P 500 equal weight up 2%. So everything that we've been talking about on the calls, if you've been a client of ours, a part of our annual or just our regular meetings, we said, expect a shift, expect a rotation, and it's happening and quickly. So sector highlights. So let's look at kind of the strongest sectors. So we saw industrials up 4.7%, materials up 4.5%, energy up 4.3%, and consumer staples, get this, up 5%, boosted by PepsiCo and Colgate's earnings. What were the weakest? Well, they were the ones that were the strongest over last year, or at least a part, maybe early in the year. Technology down 2%. Software, that subsector of technology, down 9%. Now, what were some notable company moves that maybe helped spur that a little bit on the downside? So we saw AMD. That sank after some weak sales forecast, and Amazon came out with their CapEx guidance of $200 billion. That's an increase of spend of 50% year over year. Why would that concern the market? Well, they're just wondering, is this spend going to pay off? When is it going to pay off? And what magnitude in terms of hopefully positive earnings? So that's still to be uncovered and discovered. So let's look at commodities and crypto. We saw precious metals pretty volatile. We saw silver drop to about 63.9, finishing the week down 9% at 77, and gold ended with a small gain. Bitcoin was a big loser. That was down 30% to 60,000 after gaining 1/3 of the loss. Now, U.S. economic data, we'll get a brief U.S. government shutdown that ended Tuesday. We'll get the January payrolls, but they're going to be delayed till February 11th. Now, the labor market, the indications were showing some softening, not a collapse, but softening. So we saw the ADP private payroll only up about 22,000. So we saw some slower wage growth. We saw job openings, the lowest since 2020, and we saw layoffs above 100,000. Now, who could we blame for that? Probably a little bit of Amazon and UPS putting some pretty big numbers there with their intent to downsize their employees. So we're looking at jobless claims rose, but trend was stable. Treasury yields fell as investors moved to safety, and the ISM manufacturing PMI that returned to expansion for the first time in a year, but concerns are still remaining over those tariffs, those raw material costs, those inflationary costs, if you mind. Consumer sentiment, that improved. We had the one-year inflation expectations drop to about 3.5%. That was the lowest since 2025. Now, if we go overseas globally, we saw OPEC kept March oil output pretty steady. Crude oil fell about 3.4% amid some Middle East tensions. The ECB, they held rates steady. We had the Eurozone inflation cool to about 1.7% year over year. Their core rate, stripping food and energy out, that was 2.2%. The Bank of England also held rates pretty steady as they had a split vote. And the Reserve Bank of Australia, now they're the first central bank to raise rates. They had some persistent inflation, some capacity constraints that probably led to that. We'll look at the week ahead. Well, market volatility is going to be the name of the game. We had the VIX spike to 23 and then ease back down below 18 by Friday, highlighting some quickly sentiment change shifts. So all in all, we're just getting sentiment change shifts in the AI related theme. Why? Well, they want to see this big spend. For example, what I mentioned earlier, Amazon spending $200 billion, 50% more. So who is going to be the AI winners? Who are going to be the looters? who are going to be the losers, and what is the disruption timeline for that. In the key U.S. data this week, we'll be looking at the January non-farm payrolls. We'll see the Friday's CPI report. That's going to set, or the PMI and the PPI, the PMI will set the tone for probably the CPI that's coming out on Friday. December retail sales, they're set to be released, but they're delayed from last year's shutdown. And then we'll have the option for the 10 and 30 year. We'll check the appetite for that. And then earnings, we're really wrapping that up. Earnings season's coming, winding down here, but we'll get companies like AppLovin, Datadog, Cisco, some of those tech names out there setting the tone for that area. And then we'll kind of wrap everything up with some international events. We have some elections coming through in Japan, the UK, and the Eurozone. They'll be reporting the Q4 GDP estimates, and then China will report their monthly inflation report. That kind of rounds out pretty much the global data. Jeremy?
Thanks, Graham. I had a question for you. You had mentioned kind of the softening of the economic numbers and some employment numbers or whatever. Do you see that, going into maybe a recession type scenario, or what do you think about that?
Yeah, I don't. I mean, we've been talking about this for a while, but I know it gets kind of lost in all the jibber jabber that goes on. But we expected the economy to slow down, to moderate a bit, and then possibly pick up more towards the latter part of the year into next year. And so we're not surprised to see the numbers. We think they're moderating, they're softening a little bit, but they're not collapsing. We don't expect a recession. So that should be some peace of mind. We'll just have to see how everything works out. But I think that could give some latitude for the Fed to potentially, if needed, lower rates a little bit further, maybe not a lot this year.
Gotcha. Well, Graham, we always appreciate the information and expertise, and thanking our listeners checking in with us every single week, and we look forward to seeing you next time. Have a great day.
Take care.